On this webinar today on January 6, 2012, we'll discuss what the triangle trend system is composed of. We'll discuss how disparate synergy is important in the system. We'll discuss why Renko bars are the only way to go when you're day trading. We'll discuss how to eliminate variables. We'll talk about the new swing cycle VB indicator, and we'll go into that at some length. And then we'll put it all together and show you how you can trade the triangle trend indicators. Now, disparate synergy may sound like a contradiction in terms because the dictionary definition of disparate means fundamentally distinct or different, and synergy is defined as two or more things functioning together to produce a result not independently obtainable. My explanation for this is that my individual indicators are analogous to musical instruments. Musical instruments are disparate in that there are, for instance, string, wind, brass, percussion. But put them all together in the hands of individuals who know how to use them, combine all the elements in harmony working synergistically, and you have an orchestra. In the same way, the triangle trend indicators are a disparate group that are combined synergistically to form a profitable trading system that will orchestrate profits for you when used correctly. To continue the analogy, if a college orchestra and the New York Philharmonic used the same combination of instruments, I think you would agree the results would certainly not be identical. So it's important how the indicators are used, and decisions based on these indicators is where the discretion part of discretionary trading comes in. Renko charts originated in Japan and were first introduced to the West by Steve Nyssen in his book Beyond Candlesticks, which was published in 1994. Now here's why I like Renko bars. First of all, what you see on the screen are 4 Renko bars plotted on the ES, and there are 2 triangle trend indicators plotted there. The triangle paint, which paints the bars green on the uptrend and red on a downtrend, and the triangle trend indicator itself, which puts in its final leg of the triangle when it determines that the move is coming to an end, whether it's an up move or a down move. Now, on the 4 Renko bars, each bar is divided into 4 ticks, and each tick is equal to $12.50. Now, all 4 ticks must be in the same direction for a bar to form, either 4 ticks up or 4 ticks down. If there are 2 ticks up and 2 ticks down, no bar will form. Now, Renko bars eliminate time. You don't need to look at different length charts when you trade Renko, so you're filtering out time as well as noise, and we'll get into the noise later. But speaking of noise, you eliminate spikes and tails, aka wicks, as in candlesticks, from the bars, which allows more precise stops to be set and prevents a spike or tail from stopping you out prematurely. After all, a wick, spike, or tail in the end is nothing more than noise. Renko bars also form obvious support and resistance areas, and I'll show you that later. And the other thing is that Renko bars only consider price movement. I did want to mention here that notice how Renko bars sit right on the hypotenuse of the up triangle, and that each bar starts exactly where the last bar ends, here, here, here. And you can set the triangle trend indicator itself to true when it says plot on bar close. If you do that, you can set the hypotenuse level to appear over on the side of the chart, and you can use that as a trailing stop. So as each bar is formed, that level of the hypotenuse will print over at the side of the chart. And so you can have a trailing stop with the precision of a jeweler, exactly 1 point behind each Renko bar. Now, I plotted this data box in the chart just for the purposes of illustration. You don't have to plot it on there. Now notice plot 1 here at 1252. You can see 1252 over here, and that shows that right here is 1252. Now this kind of gold horizontal dashed line here is the horizontal price line, and that plots each tick where the level of each tick is, and you can see it's at 1253. So the trailing stop is exactly 1 point behind the actual level of the equity. Here on a down move, you can see it's plot 2, that's 1233.36. You can see 1233.36 over here, and that's the level, and the bar is just below that at 1233.25 right here. The question is balance in the market a good thing or a bad thing? The answer is it's a bad thing. Synonyms for noise in the market are choppiness, consolidation, balance, equilibrium, and bars based on time. Noise occurs when neither buyer nor seller can gain control, hence you have equilibrium. Noise is the enemy of trading. Noise is a distraction. Noise will give you head fakes as well as headaches. You can't trade noise, so it is just common sense to minimize it. Question is, how do you minimize noise? One way is you filter out noise by compressing the equity. However, when you compress the equity, you compress the indicators, and so movement is more constrained. The less compressed the equity, the more obvious the movements of the indicators, but the faster the bars are formed, the more difficult they are to trade. The period type of data used is extremely important and is not given nearly the attention it deserves. Also important is what equity you are trading. YM and 6E, for instance, are difficult to trade because new bars form so fast, and of course CL is notoriously difficult to trade. The longer the time period, the less noise. To eliminate or at least minimize noise, there's another variable that can be eliminated, namely time. Plotting bars based on time produces noise. You're only interested in trading that portion of time when ticks are moving the equity either up or down. So if you trade an equity based on time, you're asking for noise because you get bar after bar plotted regardless of whether or not the equity is trending, cycling, or consolidating. Now if you Google what is the best time frame for intraday trading, you get all kinds of answers such as, quote, 1 to 5 minutes or tick, quote, it depends on your trading style and speed, but a higher time frame is less risky and less fake signals, quote, 3 minutes before European markets start and 5 minutes after that are found to be good as per my experience, quote, the 4 common intraday time frames that are used by many day traders are the 1 minute chart, 3 minute chart, 5 minute chart, and 10 minute chart. Out of these 4 time frames, the 1 minute chart and 3 minute chart will give you the better chances of entering a trade and reaching your profit targets before the market close, with the 1 minute chart giving you the best chance, end quote. All I can say here is, wow, what really bad advice to say use 1 minute chart for day trading. Now when the question is asked, what's the best bar type for intraday trading, range bars were mentioned as well as 5 minute candlesticks. Again, I say wow, because Renko bars weren't mentioned here. You don't see Renko bars really until you actually Google Renko bars. Now the whole idea of trading is to make money. It seems to me that many traders make life more difficult and complicated for themselves than is necessary, either with the indicators they use, the type of data they trade with, or the equity itself that they trade. As I said, not enough thought and attention is given to the period type of data traded. If you don't consistently make money with the way you're trading, then something is wrong, and you must change what you're doing. There are literally thousands of indicators out there. The indicators you are using may not suit your personality or style of trading. For instance, I live on the West Coast, and the ES market that I trade opens at 6:30 in the morning. There's one indicator vendor whose trading method involves preparation an hour in advance of the market opening. No matter how good that method might be, I'm just not going to get up at 5 o'clock every morning, so that method just does not suit me. Now, Here's this line represents 6:30 in the morning on the West Coast. This is a chart of the 4 Renko on the ES. Now here's the first 2.5 hours of trading from about 6:30 to 9 o'clock. You can see in here there were no trades to make here. Now the yellow dots are today's open and the purple dots are yesterday's close, so you can see the market gapped up considerably here this day. Now if I were trading the 2 Renko at the same time period, you can see how choppy that would be. But the indicators might have indicated there might be a possibility of trade somewhere along here, but I would have been just chopped up if I were using the 2 Renko. Now, this screenshot is not as clear as some of the others because I took it off a video I made. And this is a fade to gap type trade where today's open, yesterday's close. The market closed down and then moved back up to yesterday's close, and that's called fading the gap. And I got out of the trade right here where it reached the level of yesterday's close. But the point I want to make with this chart is this is where I decided to go long, to take the trade, and this is the bar I took the trade on right here. So what I'm talking about is the time interval between this bar forming and this bar forming, and the time it took between here after this bar formed and for this bar to form was 6 minutes and 51 seconds. So 6 minutes and 51 seconds of time elapsed in this space right here. So you can see I had plenty of time to get into this trade on this bar. Now I blurred the bars here so they wouldn't become a distraction, but probably this blur is more of a distraction than if I hadn't changed the bars. But the point is, if you were trading 2 Renko, this is how much noise you would have had in that same day, that same time period, that same 6 minutes and 51 seconds. From here to here, nothing but noise. If you were trading 2 range bars, 6 minutes and 51 seconds, from here to here, nothing but noise of range bars in that same time period. If you were trading 4 range bars, you would have this much noise in that same time period, 6 minutes and 51 seconds. And if you were trading the ever popular tick bars, 500 tick bars, you would have had this much noise in that same time period, 6 minutes and 51 seconds of nothing but noise. Now the point I'm trying to make with this is that, number one, you want to trade with not based on time. You want to trade Renko bars. Now if you don't trade Renko bars and you trade other bars not based on time, such as range bars or tick bars, you can see they're not as efficient as Renko bars. There are more bars in the same time period than Renko bars, and so these bars are just noise, all these extra bars, and by using Renko bars you eliminate all that noise. So if you can, let's say, prep the data before you plot the indicators on it, if you plot the indicators on efficient data, it makes the indicators more efficient. So you've got something else going for you on a trade, and that's why Renko bars are the only way to go with intraday trading. Now, look at this chart here. Here again is a line for 6:30 in the morning West Coast time. But this is pretty much just went right from yesterday, today, move along here, and came down here. And here it is roughly 7:30 in the morning West Coast time, right to this point on the chart. The day so far from here to here on the 4 Renko ES. Now on the YM, here is 6:30 in the morning, and all of this chart was filled, and you're only at 7 o'clock in the morning, so another 30 minutes was on this chart just to here on the chart, and here you're already at 7 o'clock and 30 minutes beyond that. So you've got all these extra bars, all this noise on the chart here. Now the interesting thing is, if we switch to 8 Renko on the YM, look how much it looks like the ES on 4 Renko. Comes down here, comes up a little bit, comes down. Go back, here's the ES 4 Renko, comes down here, goes over and goes down. So what you can do is essentially convert the YM to the ES. But why convert the YM to the ES? Why not just trade the ES? Because if you're trading 8 Renko bars, that's a lot of data in 8 Renko bars. It's too compressed. And so rather than compress it that much, why not just trade the ES? It just makes sense to me. Now, on another day, here's the ES 4 Renko, and here's the YM 8 Renko. You can see there is just almost no difference between the two. So if you're trading the YM, which is right here, the bars move too fast to trade 4 Renko. So you would be left with the choice of trading 8 Renko on the YM or going back and just trading 4 Renko on the ES. Now we come to cycles, and we'll get into that in part 2 of this webinar. Now, Walter Bressert, back in the late 60s, was well aware that equities trend, cycle within a trend, and consolidate. His idea was that a cycle oscillator indicator could be used to get in and out of a position at the top and bottom within a trend, and can also precede the trend. Also remember, the trend is stronger than the cycle. A problem with the conventional cycle oscillator indicators is that there is a fixed or static overbought, oversold line, and the indicator may not travel far enough to cross the fixed overbought, oversold line. So I developed an indicator I called the swing cycle VB, which has a variable band as a dynamic overbought, oversold line. Now I think we can agree that a dynamic overbought, oversold line makes more sense than a static or fixed one, because overbought, oversold is relative. It's not an absolute term. And the other thing to remember is that overbought, oversold is much more important intraday trading than it is trading end of day. Now here is the swing cycle VB plotted on the 4 Renko ES. Here again we have yesterday's close and today's open, and the solid line here is the variable band portion of the swing cycle, and the dashed line is the indicator portion of the swing cycle indicator. Now notice that there are red areas on the variable band. Here, here, here. There's a red area here and one down here. These red areas represent Bollinger Band squeezes, and as you know, a Bollinger Band squeeze occurs when the Bollinger Bands move inside the Keltner channel. When the squeeze ends, there is often a tradable move comes out of that. And as you can see here, this squeeze ended, tradable up move. Squeeze ended here, tradable up move. Squeeze here, tradable down move. Squeeze here, tradable up move. So these little red areas on the variable band are quite helpful in intraday trading, when you can tell at a glance when there's a squeeze and when the Bollinger Bands are coming out of a squeeze. Now, as to the indicator itself, I created a detrended momentum oscillator that is included in the code of the swing cycle VB indicator. So you don't see the momentum oscillator, it just colors the indicator line of the swing cycle. Now, it has absolutely nothing to do with the movement of the swing cycle itself. It only serves to color it. When the swing cycle is colored yellow, that means the momentum oscillator is moving up, but it means it's below zero. When the momentum is below zero and moving up, that is subject, questionable, because it's not a strong up move when the momentum oscillator is below zero. When it turns green, that means the momentum oscillator has moved above zero, and when the indicator line turns red, that means momentum is moving down. Now, you can see right here, when it crosses the variable band, that means this is oversold right here. It comes up here, and it goes down a couple bars, you get another squeeze, and then the swing cycle starts moving up. It's green here, so you could go long in here, and you could get out over here when it turns red. Now you can see how early it starts down right here. I mentioned earlier that the Renko bars form automatic support areas. You can see support right along here. These bars stopped right on support. But you can see they didn't break through support until over here, but the swing cycle started down way over here. So you can see the swing cycle is a leading indicator. And now over here, when it finally got through support, if you draw a straight line down here, it would hit somewhere around here. Now ordinarily, oversold lines, the oversold portion is usually plotted around 20, so it would be somewhere down in this area right around here. So if you had the conventional oscillator, you would think it's already oversold right here, but with the variable band you can see it's nowhere near oversold right in here. You can see there's a long way to go before it's oversold. Now you get down in here and the swing cycle crosses above the variable band. Yes, down here it's oversold. You can see how you can get out at the end of a trend and get in at the beginning of a trend very easily, very nicely, using the swing cycle VB indicator. Now on another day, here was the opening at 6:30 in the morning, and there was a squeeze from the previous day. Now this yesterday's close, today's open. You can see the market gapped up here this day. The swing cycle was green, moving up here. Now after the open, the market meandered down a little bit in through here, and there was a squeeze in through here, but there was a divergence here because the swing cycle really didn't move down. It just kind of went along here as this moved down. Then it started up again here, still staying green, so you could go long right in here, right around where this squeeze is ending, and come up here. Then you can see it turns red, which means momentum is going down. You can see the equity is overbought right up in here because the variable band is right up in here, and you can see it crosses below the variable band right here, which is a good indication to get out of a trade. And then the indicator moves way down here very fast. Here again, the oversold line would be somewhere in this area, and you would think when it even reaches here that it's oversold. Again, the variable band is way up here, and as it moves down here, you can see there's 3 up bars here, but the indicator ignores those 3 up bars. There's a little bit of an upward movement here, and then the swing cycle moves down, goes down here, and then crosses above the variable band right here, which indicates this is oversold right in here, and then the indicator moves on up here. Now one thing to remember is you want to trade in the direction of the swing cycle. When it crosses above the variable band and is moving up, you go long. When it crosses below the variable band and is moving down, you go short. Obviously also depending on the other indicators in the package. Now here's a CL, and you can see here there was a little squeeze, and the swing cycle crossed below the variable band right here, which shows that this was overbought right up in here. it moves down here, comes up a couple bars, comes down, goes up 3 bars here, but again the swing cycle ignores that, shows a couple squeezes in here, comes right on down here. Here again it's yellow, which means not a strong up move, comes over here and right back down here. And again, if you were using a conventional oscillator, you would think it was oversold right down in here, which is not, because the variable band is still up in here. And it comes down here, and here is where it's oversold, and that's exactly the low point of this day or this time period. And then the swing cycle moves above the variable band right here, goes on up here. Again, it's yellow, which indicates not a strong up move. The equity moves back down 3 bars here. This stays green and moves down, and then when it starts up again, the bars turn green, and then this is a good point to go long right in through here. Now here I've added one of the other indicators called the DMI differential to the package, and you can see how it is used along with the swing cycle VB. Now the DMI differential is my version of the DI plus, the DI minus, and the ADX all combined. Now when you're in the heat of battle and you're in the middle of trading, looking at the 3 lines of the DI plus, DI minus, and ADX can be a little bit confusing. And also there was a controversy about the ADX as to where it shows an uptrend. Does it have to be above a certain level, or does it depend on the direction of the movement of the ADX, or is it both? So I eliminate those questions with this indicator. It's easy to use, quick glance indicator that tells you what the status is. Now, what the 0 line does with the either red dots or green dots, it tells you that there was an upward bias to the equity. So there's an upward bias right in through here. But the indicator line itself stays red and stays below those green dots. So you know it's not an upward move of the equity. You can see this is the trend down through here, and this was just a retracement of that trend. So it was just a head fake to the upside. So you would not fall for that by combining these indicators. So you can see here, you would have not gone long down here when the swing cycle indicated the equity was oversold right here. So here indicates oversold, and indeed it does go up here. And the swing cycle variable band moves up here, and if I could kind of coin a word, it gets rid of its oversoldness right in here as it goes up here. Then the swing cycle crosses below the variable band right here, and then that shows it is overbought now right in here. And this indicates what I said previously, that oversold, overbought are relative terms trading intraday. Now this moves down here and flattens out down here. The variable band catches up with it, and the downtrend slows down right here. Now look at the gap between the red dots and the indicator here. Now there's no indication that the equity is going to move up. Also with the swing cycle being yellow, that indicates it's not a strong up move. It comes up here and then starts down, and then the equity looks like it continues on down here and goes off the chart. Now here is the ES on another day, and you can see a squeeze right in here as the variable band crosses above the squeeze. And you can see, however, here that the DMI differential dots were red and the indicator line was red. Now what I wanted to point out is you have higher lows here and higher highs on the swing cycle, and then you got a little squeeze in here, and so on this bar I decided to go long, and this bar I went long, and you can see just on this bar finally the DMI differential turns green and is crossing above the dots right on this bar. I got out of the trade right here where I put in this red diamond because the variable band is right up here, which indicates the equity is overbought, and the swing cycle is starting down through the variable band right up in here. So I got out of this intra bar right here before this bar actually formed. And now if you look closely, you can see the purple dots here partially hidden by the text, and you can see what this was a fade to gap trade up here, and then another fade to gap trade down here. I got in the trade after this little squeeze right in here, got in the trade on this bar here as the swing cycle was moving down, and the DMI differential was crossing below the dots. The dots were red in here, and then I got out of the trade when it hit support at today's open. Now I just put this chart in to show you that what I said earlier, that cycles occur within a trend. So you can see this is obviously a downtrend here. The swing cycle is cycling above and below down here. But if you went short up in here somewhere, you would stay in that short position because you can see the DMI differential stayed well below the dots here. The dots turned green, which meant an upward bias right in here, just a retracement of the downtrend. And again over here, 4 green dots, a little bit of an upward bias here, but again not anywhere near crossing above the 0 line here. So that's how you can stay in a trade much longer using this than you ordinarily would with just about any other method of trading that I know of. Now here is all the indicators put together, and I'll go through them individually with you and show you how they all function together. Now you're familiar with the indicators up here, and you're familiar with the DMI differential. This is the binary triangle indicator right here, and it's either long or short. It either shows a downtrend or an uptrend. When it turns red here, it's showing a downtrend. When it turns green over here, it's showing an uptrend. And it is the same basis or basic code as the triangle trend indicator itself, except the binary triangle, when plot on bar close, it's set to false. So it plots in real time up to the tick, whereas the triangle trend plots at bar close, and so it shows this downtrend has come to an end here, but the binary triangle doesn't agree with that. Now this other indicator here that has turned green, that's the DIX or disparity index indicator. Now that indicator was also introduced by Steve Nyssen in his book Beyond Candlesticks in 1994. Now the DIX or disparity index is very similar to the detrended price oscillator. It's not the same, but it is similar, but I think it's better. I think it's a little more sensitive, a little more accurate. Now the crucial portion of this indicator is what type of moving average is used in the indicator, and that's extremely important with this indicator, and I'll show you why in just a second. Also, the length of the moving average here is important. So I took a lot of time trying a lot of different combinations here to get the ideal one, and I found it works quite well when plotted in the same panel as the binary triangle right here. Now basically the way this indicator works is if there were a moving average coming right down here, and the moving average lags a little bit and comes down here, and the equity closes above that moving average right here, and you can see that turns the indicator green. So it doesn't matter if the moving average lags behind the equity with this, because it's where the equity is in relation to the moving average. So when it crosses above it, it closes above it, then that triggers the indicator. And so then the moving average can catch up with it later. It doesn't matter. Now, the DIX, as I said, was introduced by Steve Nyssen. So the version that I've seen available for Ninjatrader doesn't have a zero line and isn't color coded. So I color coded the dicks and I put a zero line in, and that's a complementary indicator that you will receive if you purchase the triangle trend package of indicators. The other complementary indicator that you receive is the linear regression slope, or the LRS. Now, the LRS comes with Ninjatrader as well, but it doesn't have a zero line and it's not color coded. So that's why I include this also as a complementary indicator when you purchase the package, because I put a zero line in and I color coded it. Now, the interesting thing about linear regression slope is what it does basically, it converts the equity into a straight line, and the straight line is the zero line here. So when the linear regression slope moves above the zero line, that indicates the equity is moving up. When it moves below the zero line, that indicates the equity is moving down. Now, I plot the R-square in the same panel as the linear regression slope. This line here is 0.4 and this line is 0.7 related to the R-square. When the R-square crosses above 0.4, that indicates a trend. It doesn't indicate the direction of the trend, but just indicates that the equity is trending. When it crosses above 0.7, that indicates a strong trend. So the linear regression slope is moving down, indicates the trend is down. This indicates a strong trend down. Now, the significant part is where they cross, right in here. And when this all lines up with the other indicators, then that's a very significant cross. That shows the beginning of a trend right in here. It corresponds with the other indicators, and when you see a potential trade like this, if you enter this trade, there is better than a 95% chance that it's going to be a profitable trade. Now finally, there's the Bollinger Band Differential Oscillator. When it's above its zero line, that means the equity is in an uptrend. When it's below the zero line, that means the equity is in a downtrend. And you can see right where these two cross, right here, the indicator line of the Bollinger Band Differential Oscillator was just about to cross below the zero line. So here we have a squeeze. Here we have the swing cycle VB was already down at the bottom, moving along here. The DMI differential was red and crossing below its red dots right here. The binary triangle had formed here. Linear regression. The dicks should form right before the binary triangle forms, and it turns red right in here and moves down here. And you've got this cross of the R-squared linear regression slope right here, and then the Bollinger Band Differential Oscillator is just about to cross its zero line. And you see this not all the time, but quite frequently. Now, the other times you rely on the preponderance of evidence of the indicators. Everything doesn't always line up like that. For instance, the linear regression slope might be moving down, but a trend doesn't start right where the other indicators indicate going short. So if all the other indicators lined up, I would still take a short position, because very often it doesn't start trending for another bar or two afterwards. Now, if you want to be conservative and cautious, you wait till these two indicators cross right in here. So because you're dealing with a preponderance of evidence, here you've got a downtrend. Now here you've got still a downtrend. It looks like it's about to end here, and you've got a downtrend on the LRS. So the other thing, the important thing here is the DMI differential is red. The dots are red, so it shows there's not even an upward bias to the equity here. So you would stay in the trade right in here that you would get into on this bar right here. That's where you would enter the trade. And the swing cycle is crossing above the variable band, which shows it is relatively oversold right in here. But this is yellow, moves up and then turns red, and this starts down here. Now, to continue on this same equity, same day, same time, here's what we were looking at before, where the dicks moved up here, was turning green, and this is that area of the chart which really wasn't an up move. So you can see you've got a long downtrend right in here, which you entered on this bar right here, and which you obviously can stay in here. You can see a little bit of an upward bias here, but the indicator stays below that, and the Bollinger Band differential oscillator stays below zero here. So you would stay in this trade all the way down here, and I would get out of the trade right around here when these two cross going in the opposite directions. You can see the trend is ended down here because R squares shows trendiness. When it is below its 0.4, that means there is no trend. When it's above its 0.4, that means there is a trend. So the downtrend is ended, and obviously before an uptrend starts, the downtrend has to end. So this is where I would get out of the trade because the trend has ended. Now, generally speaking, with the ES, you get a nice strong down move here. It flattens out, goes down again. Chances are it's not going to flatten out and go down again. Chances are it's going to go up a little bit here, even if it does start down again. So this is a good point to take your profits off the table on this trade right in here. Now, I like to use Fibonacci sometimes, and I'm using this here for illustration purposes. And what I do is I use the bottom part of a triangle on an up move here, and I put the Fibonacci in right here on the highest point of the last up bar. And Fibonacci levels are easy to plot with Ninjatrader. You just have to press F8, and that sets up being able to plot the Fibonacci retracements. Now you can see here's the 50% line and 61.8% line, and this was an uptrend here. So when the equity starts down, the question is this a reversal on an uptrend, or is this just a retracement of an uptrend? So you can see the equity came down and stopped right on the 50% retracement bar. Between the 50% bar and 61.8, this is called the ambush zone right in here. If it stays within this area and starts back up again, then that indicates that the uptrend is continuing. And so I wanted to point out to you on the Bollinger Band differential oscillator, it went down close to the zero line, but never crossed below the zero line, and so it correlated with the Fibonacci retracement here, which shows this was a retracement of an uptrend and not the beginning of a downtrend. By the same token, you can do that on a downtrend. You start the Fibonacci line right here on this base down to the bottom of the lowest bar, and you can see here's 50 and here's 61. The retraced right back up and stopped on the 61.8 retracement, and there was a squeeze in here. The DMI differential was moving down here and was red. The DIX was moving down. There was a down binary triangle formed here. The linear regression slope was moving down right in here, and the Bollinger Band differential oscillator was below its zero line and was moving down through the Bollinger Bands right here. So I went short right here, confident that this was not an uptrend here, but just a retracement in a fairly long downtrend. And so I rode this down and I got out of it right here, and frankly I have no idea why I got out of the trade right here. I don't see any good indication why I did, but for whatever reason at the time I decided that was where I wanted to take profits. Now here's another this is what I call a BTF trade, or bet the farm trade. Here's open 630, and here's the swing cycle crosses below the variable band crosses below the swing cycle right here, which indicates this is overbought right in here. You can see the DMI differential is red, move down here, the dots are red. There's a down triangle here. The DIX is red and moved down here. It's a little bit behind the binary. You can't see it, but it's red moving down here. The linear regression slope is on its way down, and the R squared is on its way up, and the Bollinger Band differential oscillator is crossing below the 0 line right here. So now here, now I got out of the trade right here. I took profits. Now I would have been more adventuresome and stayed in this trade and followed my indicators, which you can see right here. It indicates an upward bias, but no way does it show that the equity is going to start moving up, although the R squared moved down here, indicating the trend had ended, but the Bollinger Band differential oscillator stayed way below 0 down here. But I got out of this trade here because even though I was in the trade for quite some time, it wasn't that steep a down move, and there wasn't that much profit in here, so I decided to take my money off the table right here when the swing cycle indicated that the equity was oversold right in here. And once again, going back to that oversoldness word, it showed that it was overbought right here. So on the next bar, I went short right in here and got out right in here. Now there was a reason to get out here. These R square was moving down, was about to cross its 0.4 line here, and the DIX turned green and was moving up here. So once again, there was not a lot of profit involved in this trade, so I took my profits off the table right there. Here's another very similar trade. Once again, the indicates that the equity is oversold right here as the swing cycle moves above the variable band. All the other indicators are showing go long here, LRS is going up, R square moving up, the Bollinger Band differential oscillator is above its 0 line moving up, so I went long here. Now I got out over here when there was a squeeze, so I knew there was going to be a change of direction, and the swing cycle was moving down below the variable band right here, so here we are overbought. I went short right here, followed the direction of the swing cycle, which was red now. There was a down binary triangle here. The DIX was moving down. Linear regression slope was moving down. The R square was moving up right here. And this was the only question in it, that the Bollinger Band differential oscillator was still well above its 0 line, but the Bollinger Band differential oscillator had squeezed right in here, and the indicator line was crossing through the Bollinger Bands right here, and the midline just started to turn red right in here. So I felt this was worthwhile to take this trade, and I shorted it, and then I got out when it got down to yesterday's close. And also you can see it was oversold here as the swing cycle was about to cross above the variable band right in here. Now this is another way you can trade, just another little trick you can use in trading these triangle trend indicators. What I did here is I saw that there were two bars that served as resistance. Came up here and it came up here, so I drew a horizontal line across these bars with the idea I was going to go long when the equity crossed above that. So I set a buy stop a quarter of a point above this line that goes through here. So I knew that when the equity moved above this with a buy stop set in advance here, a buy stop becomes a market order, and market orders are filled in the order received. So it's a policy of first in, first out. I knew when I putting the order in advance, when that level was hit, I would get a good fill there, which I did, and went long on this bar here. And then we got into this overbought condition right here, so I got out of the trade right up in here. Now the other thing I wanted to point out to you is that you can draw trend lines on the DMI differential, and you can see I drew a trend line across these two peaks on the DMI differential, and it crossed above that trend line right here, right when the equity moved above this resistance line right in here. Also, you can see the LRS was moving up, and so was the R square right in through here, and the Bollinger Band differential oscillator was well above its zero line right in here. Now this is that same chart, and you can see that right here the high was 1220.75, and right here that same high was 1220.75. so I set the buy stop at 1221, and that's where I entered this trade right here, and then I got out up here for a couple points profit. And